Good afternoon, ladies and gentlemen, and welcome to the first of two charity webinars from PKF Francis Clark, which covers the content that we went through last Thursday at our charities conference at Buckfast Abbey. My name is Neil Hitchings, and I'm an audit director based in our Exeter office, and I will be chairing today's webinar. We are recording the session, and we will be sending out a link to the slides afterwards, but after we've done next week's webinar as well. Please do post questions in the Q&A tab, which hopefully you can see on the left-hand side of your screen, and we will do our best to cover these off at the end of the session. So in the next hour, if we can move on to the agenda, Darren Perry is going to take us through an update on the exposure draft of the charity SORP and some of the key issues that charities will need to start thinking about. Then Sharon Austin will talk us through some of the common themes coming out of Charity Commission inquiries and some practical tips on fall prevention. And then finally, we're delighted to welcome Miles and John from Triodos Bank, who will tell us about some of the ways they're working with the not-for-profit sector. Just a reminder that our second webinar is at the same time next week on the 1st of July, where we'll be covering topical issues on VAT and employment taxes. So without further ado, I'm going to hand it over to Darren to give us an update on the charity SORP. Thanks, Darren.
Okay, thank you, Neil. Good morning, everyone. For those of you that don't know me, I'm Darren Perry. I'm a director based in our Truro office, primarily looking after our charity and not-for-profit clients. So for today's session, I'm going to run through some of the proposed changes to the charity SORP that are based on the exposure draft, which has recently been out for consultation. So I'm going to run through the timetable for when it's being implemented, and then have a look at the main changes around the tiered structure to reporting, income recognition, and lease accounting. Now, I would stress that my comments are based on the exposure draft, like I've said, so that hasn't yet been finalised, and therefore some of the things that I mentioned could feasibly still change in due course. But primarily, I just want to give you an overview of likely changes so that you can start to think about how they might affect your charity. And obviously, in due course, once the final version has been published, we'll be able to give you more technical guidance on the individual topics. Okay, so just as a reminder then, the SORP, or Statement of Recommended Practice, that's the formal guidance setting out the accounting requirements and disclosures for charities. So the SORP has to be followed by every charity that's preparing accruals accounts. So generally speaking, that's going to be charitable companies, all charities with income over 250,000, and then also any smaller charities who may have chosen to follow accruals accounts rather than receipts and payments accounts. So as I mentioned, the exposure draft has recently been out for consultation, and there is a link on the screen if any of you wish to access the exposure draft to have a look at the more detailed content. So in terms of the timeline, the consultation on it actually closed last Friday on the 20th of June, and we're expecting the final version to be published in the autumn of this year. But the important date for everybody's point of view is that it will become mandatory for reporting periods beginning on or after the 1st of January 2026. So for the vast majority of charities, that will mean 31st December 26 year ends onwards. But do watch out if for any reason you have a short reporting period next year, as it could kick in early. And as is usually the case, the SORP will be available for early adoption if you wish. So if we go on then to look at some of the proposed changes, well, firstly, they brought in a 3-tier income-based framework to the SORP. So you might remember in the current version of the SORP, for example, on the trustee report, they've currently got requirements for all charities, and then they've got additional disclosure requirements for what they currently refer to as large charities, which is those with income over £500,000. That's been changed in the proposed new version of the SORP, and we've got 3 formal tiers, as you can see there on the screen. So as an example, if you're a charity with £1 million income, you're going to fall into tier 2, which basically means you need to adopt all of the requirements and disclosures in both tier 1 and tier 2. Now, whilst they refer to these tiers throughout the whole SORP, it makes the most impact on the trustees' annual report. That said, there is still a strong encouragement that charities should consider including information in their accounts based on the requirements of higher tier charities, particularly if that is relevant to the sort of work that they do or the charity stakeholders. Now, overall, there are some additional disclosures, and they've certainly rewritten the guidance quite a bit. So we will notice some rephrasing of the guidance, and I think at the smaller end, there are now more requirements that are being put on all charities of all sizes, as we'll see, and I'll go through in a moment as we look through some more of the changes. So just as an illustration of that, let's start by looking at the achievements and performance section of the trustees' annual report. So at the moment then, in the current version of the SORP, all charities must give a summary of the main achievements of the charity in the year. And then there currently is a should, that they should identify the difference the charity's work has made to the circumstances of its beneficiaries, and if practical, explain wider benefits to society as a whole. If you then look at the new wording in the new SORP, the same basic requirements are in there, but you'll see that they've effectively rewritten the guidance and also made all of the aspects a must. So the trustees must now provide answers to the questions: in what way has a charity's work made a difference to its beneficiaries, and has a charity's work provided any wider benefits to society as a whole? And that bottom line on the slide there is also the other theme that is definitely running throughout the new SORP, and that's around impact reporting, and trying to make sure that you give examples in your trustees' annual report to help communicate your message more clearly. So for example, there it says the use of infographics, statistics, beneficiary and volunteer testimonials may help communicate this information about what the charity has done. And if we move on and look at the second tier requirement for achievements and performance, that same theme is brought up again. So Tier 2 charities are required to explain the impact that the charity has had and its long-term effects on its beneficiaries and on society. And again, they've gone on to stress the use of personal beneficiary impact stories may be of value in communicating that message. Now, I know quite a lot of charities do already include quotes and stories in their report, but that is something that is very clearly being encouraged more and more for all charities. So that is certainly something to bear in mind. And then I'm just going to run through a few of the other changes in the trustees' annual report. So in respect of volunteers, charities of all tiers are now required to include an explanation of the scale and nature of activities undertaken by volunteers and the impact that it's had. In respect of reserves, there are a few more requirements, particularly for the smallest charities. So, for example, it's now a requirement for all charities to include a formal comparison of their reserves level with their stated reserves policy and comment on the differences. Again, in the current SORP, that was just required for larger charities. So again, we're seeing some of the disclosure requirements move down to Tier 1. And there's also recognition in respect of legacy income that for many charities, when they receive a one-off legacy, it can actually make quite a significant difference to their financial performance. So there is now a requirement that in the financial review section, if you're Tier 2 or above and you've received a material amount of legacy income in your accounts in the year, that you should explain the impact of that in the narrative to help give a clearer picture to the reader of the accounts. And then also in respect of plans for the future, again, it is now proposed that all tiers will need to include a summary of the charity's plans for the future. Again, not just the larger charities. Now, one new section that's cropped up in the trustees' annual report that applies to all charities is a new sustainability section. So Tier 1 and Tier 2 charities are now encouraged to explain in their report how the charity is responding to and managing environmental, governance and social matters. And that requirement becomes a must for Tier 3 charities that also then have to put in further disclosures around things like social opportunity, privacy, data security, diversity and business ethics. Okay, so that's some of the changes on the trustees annual report side. Moving on then, while the Charity SORP committee have kind of taken this as an opportunity to sort of do a fairly full rewrite of the SORP, the changes were initially driven by changes to FRS 102, which is the underlying accounting standard in the UK, which was being brought into line with international standards. And that accounting regulations has had some quite significant changes to how you approach income recognition and lease accounting. So those changes have now also had to be fed into the SORP, and I'm just going to pick up those two sections now. So starting with income recognition then, sorry, if we can just go back to the last slide. Thank you. So what the Charity SORP has done has split the income recognition module into two separate sections. We've got income from exchange transactions. So that's where the charity is supplying goods or services under a contract. So for example, if you're an educational charity putting on courses in exchange for a course fee, that would be income from an exchange transaction. And then in contrast, income from non-exchange transactions, that's where you receive a donation or a general grant, but the charity isn't providing equal value in exchange. Okay, so if we just look at income from exchange transactions first then. Now, it's now laid out in terms of your recognition. There are now 5 steps that you need to go through to work out the best way of recognizing the income from an exchange transaction or a contract. Now, I would stress at this point, it's perfectly possible that you can go through all of these 5 steps and come back to the same answer that you've already got in terms of how you recognize your income. But there may be some examples where when you do this process, you get a different answer in terms of timing, for example. So it is important that you do think about all your income streams in the context of these 5 steps I'm now going to go through. So firstly, you need to identify what contracts that you've got with third parties. So a contract is effectively something with, enforceable rights and obligations between yourself as a charity and the customer. You then need to look at the performance obligations in that contract. So for example, is there a distinct good or service that's delivered separately? Is there a series of obligations that you've got to meet? And are they met at one time or over a period of time? So you need to look at all the different obligations that you've got under that contract. You then need to determine the transaction price. So how much are you charging for this work? And that might be straightforward, but equally it's possible that you may have built in, some sort of discount or rebate in it, or it may vary depending on, how much work you do. So you need to determine the transaction price, and then you've got to split that price between the individual obligations within that contract on a fair basis. Again, that may be straightforward. For example, if it's just, separate goods and services that have all got a separate selling price, but you've got to come up with a sensible way of allocating that price to each individual obligation. And then the income recognition basically just follows that. When you've met one of those performance obligations, you recognize that element of the transaction price, and so on. So just as an example, if that recognition is over time, if you are putting on a training course of 10 sessions, for example, you might recognize a chunk of the total course fee after each session is completed. In contrast, if you're it's just one service that's met at one point in time, when you've supplied that good, completed that piece of work, then all of the income is recognized at that point. Okay, if we're moving on. So that's the basic process, and I think it probably can be a bit more complicated for charities sometimes because they will have various forms of income that could fall within this process or not. So one example in the SORP is membership subscriptions. So if your charity receives a membership subscription, firstly, you need to decide what type of transaction that is. Is this effectively just a donation to a charity that you may recognize at that point in time, because really the member isn't getting, specific benefits or, performance obligations in exchange? It's really just a donation. So would you just recognize it at that time along with any related gift aid? Or are they actually buying a right to services from that subscription. So, for example, if that membership subscription gave them annual entry to the charity's gardens or the charity's buildings, you would then have to work out a way to allocate that income. Now, you probably don't know how many times that member is going to visit your property over the course of that year. So it might be that you just end up adopting a straight line process because you're obliged to keep that property open so members can visit it. So perhaps you'll just recognise your income on a straight line basis over time. But that's the sort of things you need to start thinking about in terms of your income. And then in respect of non-exchange transactions, like I said, that's really just when a donor or a grant funder is effectively giving you some money for the charity's work. And generally that's going to be recognised when you receive it, or if it's receivable, unless there are still very specific future conditions that need to be met before you're entitled to it. Or if, for example, if you're given a grant, but it needs to be spent in your next year, well, you'll then recognise it when you get into that year when you're allowed to spend it and become entitled to it. So we may still have the situation that you have now sometimes on grants, where perhaps a grant funder's given you the grant up front, but an element of it has to be spent in the next financial year, so you'll end up deferring a chunk of the money until those conditions are met. So that hasn't really changed a great deal, but the presentation has. Okay, moving on. And then just a couple of other bits on income. The exposure draft of the SORP does include much greater disclosures around income, particularly contract income. So descriptions of, how the charity decides when its performance obligations are met, whether it's got any deferred income and so on. I'm not going to go through those in detail, but there is some additional disclosure requirements in there that you'll need to bear in mind in due course. And the other thing that they've expanded in the SORP is around a legacy income, and there is a bit more guidance on that, just about how you determine whether receipt of a legacy is probable and whether it can be measured reliably. And one of the things that they've added into the guidance is that you do need to take account of post-balance sheet events. So, for example, if at the end of the year you believed that the receipt of the legacy was probable and you had a reliable measurement of it, you may have recognised it in the accounts. If after the year end you get notified by the solicitor that perhaps the will is now being contested, well, does that mean it's no longer probable that you'll get that money? And if that's the case, that would be considered to be an adjusting event, so it would probably affect your recognition as at the year end. And so there's just a bit more guidance in there around legacies. One point I haven't mentioned on income generally is about restatement. So the charity SORP is going to allow you to either restate your comparatives if there is a significant change. So if this change means your income is going to be different last year if you'd applied the different rules, you have a choice of whether you restate the comparatives, or you can simply make an adjustment to opening funds at the start of the year for any effect that it would have had. Okay, moving on. So the second significant change is about leases. So at the moment, we've got two types of leases. You've got operating leases, which you generally just treat as an expense going through. And then you have finance leases that might be on your balance sheet as an asset. Going forward, we're no longer going to have that distinction. So all leases are generally going to have to be brought onto your balance sheet as a fixed asset. So effectively, what we're saying is if you've got an operating lease on a car or a van, for example, at the moment, you would be just putting that through as an expense each month. But going forward, it will be an asset on your balance sheet, so a right of use asset that you can use that car, and there'll be a corresponding liability. Now, as a simplification, there is going to be an exemption for short-term leases. So that's those leases that are less than 12 months long and have got no purchase option. And there's also going to be an exemption for low value assets. Now, low value assets aren't strictly defined, but it does tell you some of the things they're not. So cars, vans, and land and buildings, for example, would not be low value assets, and so wouldn't fall as part of this exemption. So really, I think we're talking about things like, the photocopier, the franking machine, a laptop, the water cooler. Those sort of assets are going to be treated as low value and would be exempt and can carry on being treated just as a monthly expense. But an interesting point on that is it is about the nature of the asset specifically rather than its value. So if you're a charity that's got an operating lease on one van, that's going to have to go on the balance sheet as an asset. But if you've also got a lease for 50 laptops, even if they individually come to a higher amount, they are low value assets by nature, so can be treated on the monthly basis. Now, there's an awful lot of detailed guidance in the SORP and in the accounting regulations on how to treat leases, and I'm not going to go through that in detail because it could be a seminar in its own right, but I'm going to try and give you a very simplistic example just to show you the sort of process that needs to be done and how it might affect your balance sheet. So let's take the example that you've entered into a 5-year property lease at £10,000 a month from the start of this year. We're going to assume you've got a 31st of March year end, and for the purposes of the example, we're going to say that you could borrow from the bank at 6% interest per annum. So at the start, your total commitment under that lease is going to be £10,000 a month for the next 5 years, or £600,000. So your March 25 accounts, what are they going to show? Well, you're just going to have 3 months rental lease expense going through, which would be 30,000. Your March 26 accounts, well, they're going to have a full year of lease rental payments going through of £120,000. And then you're also going to have an operating lease commitment note saying that at the 31st of March 26, you had an outstanding rent commitment of 450,000. So that's what you've currently got. So when these rules come in on the 1st of April 26, which is going to be the first day of your first accounting period under the new rules, you're going to need to work out the present value of your committed lease payments. And you're going to need to do that by firstly deciding on an appropriate discount rate to use to effectively work out the present value of the future amounts you're going to have to pay under that lease. So that discount rate could be the interest rate implicit in the lease. It could be the borrowing rate that the charity can obtain from its bankers, for a similar liability and term. Or if the charity never borrows, then the SORP does say that it might be the case that a charity will need to use the interest rate it could obtain on its deposits to try and do this. So if we discount back all of your future remaining lease payments of this lease, we get to a figure of £392,000. And that's going to be your right of use asset and your future liability effectively on day one in this simple example. So if we then move on and have a look at how that will then show in your accounts. So like I said, on day one, you've got a new asset of 392,000. And I would say for leases, there is no restatement of comparatives. So effectively, you adjust this at the starting point in time. You don't go back and restate the prior year. So in our first year of accounts, we've got that right of use asset in there, and you're going to depreciate that asset like you would any other asset. So we're going to depreciate it over its useful life or the lease term. So that will mean in the year to March 27, you'll have £104,000 of depreciation going through and a closing asset at the year end of 287,000. And then on the flip side, on the lease liability, where we started with a liability of 392,000, you've made your monthly repayments of £10,000 a month. So that's knocked £120,000 off your liability. But we're going to have to unwind the discount, and there's some interest to be incurred effectively on that liability. So we're going to add on the interest, and at the end of it, the year, your closing liability in this example was £295,000. So what difference has that made to your statement of financial activities? Well, under the current SORP, you would have just had a rental expense going through of 120,000. under the new proposed treatment, you're instead going to have a depreciation charge of 104,000 and an interest charge of 23,000 for this first year. And generally speaking, because of the way the interest is calculated and the size of the lease liability, generally speaking, you're going to probably have a higher expense in the early years because there's more interest on your liability, and that will reduce down, and then in future years it will be a lower expense. But that's basically the different presentation that it's going to have in your accounts. So does this matter to anybody, other than your accountant? Well, potentially. So as we've seen, it's going to increase your gross assets and your total liabilities. So at the moment, one of the charity audit thresholds is, it's income of £1 million or income over 250,000 and gross assets over 3.26 million. So if you're suddenly including a significant amount of additional assets, it is possible it could push you over that audit threshold. And equally, the expense in the accounts, as we've seen, it could change your surplus or deficit for the year, and you're going to have interest and depreciation going through rather than rental expenses. Now, that may have less effect, and it probably impacts sort of commercial businesses more significantly. But if you have bank borrowings, for example, do you have any covenants that you've got to meet as part of those loan arrangements? And how are those covenants calculated? Would the fact that you've now got interest and depreciation rather than rental expense change that calculation? So it is worth having a think about that. So very much in preparation, start to think about the leases that you've got. Are they ones that are going to have to go on the balance sheet? And if so, have a good look at them, get an idea as to the impact it's going to have on you and whether that's something that you need to start thinking about in advance. Okay, then just touching on a couple of final comments really from me. Peppercorn rents, the charity SORP does mention that obviously some charities do get peppercorn rents. They're probably unlikely to meet the lease definition in their own right. So they're probably still going to be an operating expense, but that doesn't mean that anything's changed with how you would recognise them. So if you're, for example, have got use of land or buildings for £1 a year, but if you're using that for your charitable activities and you would have had to purchase that facility or asset or service, had you not had the peppercorn rent arrangement in place, then you should still really be recognising that at the value of the service that you're getting and treating that as a donation in the accounts. So that's just one point to mention. And then finally from me, I've just picked up another 2 or 3 points in the accounts that I just wanted to run through, in the SORP. So you'll notice there's a lot more cross-referencing to the underlying accounting regulations FRS 102. So you will see cross-references in the SORP to that guidance. So it just helps the user of the SORP find further supporting information to work out how to treat something. Tier 1 charities, so the smallest charities, they're allowed to use what's called a natural classification on the statement of financial activities. So, the larger charities have to have, for example, cost of raising funds, cost of charitable activities, and so on. Tier 1 charities are allowed to use natural classifications, and they've now put in an example of that, like the little clip you can see there on the right-hand side. So your expenses, you can break them down by category, so salary, premises, grants, interest, depreciation, and so on. So there's an example there that can be used. There's a new section in the SORP for provisions, contingent liabilities, and assets and funding commitments. That in itself, there's no real new information in that, but they've basically taken the various aspects from throughout the SORP and put them in one place for easy reference. And then finally from me, I'll finish with some good news after all those changes. Going forward under the new SORP, only Tier 3 charities are going to be required to prepare a cash flow statement. So at the moment, all charities with income over 500,000 have to put a cash flow statement in their accounts. and they're getting rid of that requirement, so it will only be the largest charities that have to do that. So hopefully that's a small simplification. And that's it for my update on the upcoming changes to the charity SORP.
Thanks, Darren. That was really helpful. Got one question coming through on the Q&A, which we'll try and pick up at the end, and I'll let Darren ponder that in the meantime. And just to say, yes, you will get copies of the slides afterwards. So without further ado, we'll hand over to Sharon to give us an update on the Charity Commission, what it's been up to.
Thanks, Neil. And I've just noticed I've clearly got my on-camera jacket and necklace combo on because the photo's got the same on. So moving swiftly on from that, please, Ruth. So I'm a slight change in focus here. No tricky maths in my bit. I'm going to look at some Charity Commission inquiries, sort of triggers and some themes that have come out of the findings, and then just move on to some practical aspects of fraud prevention, particularly with the relation to trustees' responsibilities. So starting with Charity Commission inquiries and what might trigger them, you'll see on the slide there, there's a number of sources that feed into the Charity Commission that might trigger an inquiry. They don't have huge resources within the Commission for conducting inquiries, so they need to be very careful about their risk management and make sure they focus those resources in places they're needed. So in the 23-24 year, they actually opened 89 new statutory inquiries and closed 65. And given that there are approximately 170,000 charities on the register, you can see there's only a very, very small number that actually come under the full scrutiny of a statutory inquiry. In the context of that, actually, the number of serious incident reports that they received in that same period was just over 3,000. So I know sometimes trustees are concerned about submitting those reports, but it's not inevitable that if you submit a serious incident report, it will lead to an inquiry. It's worth noting that if there is a live inquiry opened, the starting point is that will be transparent. So there will be, if somebody goes to your charity entry on the Charity Commission website, there will be notice of that inquiry, and it will be public unless it would be either prejudicial to legal proceedings or it would actually place individuals at risk. So stat inquiries are a relatively small number. Part of trying to work efficiently is, again in the 23-24 year, the Charity Commission actually undertook a class inquiry. So just moving on to the next slide. So this was where they tried to pick up charities which were late more than 2 years in the last 5 in their statutory submissions, and this was after all the normal warnings and encouragements to get things up to date. So they launched an inquiry, and those charities that were still had those documents outstanding at that point were swept up into this. What were the findings of that inquiry? So there were 38 charities actually then brought their records up to date, which apparently accounted for additional 251 million of income coming onto the public record, which, given that's 38, that's over £6 million as an average per charity. So there must have either been some very big ones or over a number of years for some of them. But that effectively, that the inquiry did what the aim was, which was to bring things up to date. 9 of the charities were found to have ceased. They'd run their course, so they could just be removed. And it was in 4 cases where the late filing was the tip of the iceberg, and there were other governance issues. And so those led on to full statutory inquiries. I have spent a little while just flicking through the findings of a number of the Charity Commission inquiries, and there were definitely recurring themes, which I've just put on the slide there. But I thought it'd be helpful to use a case study just to highlight some of the key areas. And I was in 2 minds. I've gone for Captain Tom. The risk is, it was all over the news, it's old hat, does everybody know all about it? But when I thought about it, actually, if you tried to invent a case study with issues in it and came up with as many areas of concern, missteps, trip hazards, things that you would hope people would spot as they were going along, you wouldn't actually come up with anything like this one. You'd think it was implausible. So I think it is worth using as a case study. This is obviously referring to the Captain Tom Foundation, so nothing to do with the funds that were raised for the NHS charities during COVID when this all started. But when they moved to the formal setting up of a charity, and just, I'm not going to rehearse all the background because I think everybody was aware of what went on, but just because it's relevant, just to be aware that Captain Tom did actually assign his intellectual properties, who used his name, to a family trust, and it was a company under the family's control, Club Nook, that then trademarked that name and that assets. So what I'm going to do is just dive straight into the findings section of the report. It is worth a read if you've got time and you haven't read it already. But each of the individual findings has got a section. I just want to pull out some key bits for us to be on our guard or make sure that we're thinking about in our own charity. So to start with, Hannah Ingram Moore was appointed a trustee of the new charity in Feb 21, but she stood down in March 2021 because she identified that she thought her role was more akin to a CEO than a trustee. And at the time, she indicated that she had an expectation to be paid for undertaking that role, and she gave the trustees an indication of a sort of £150,000 salary as being what she felt was appropriate. Now, the non-conflicted trustees properly identified that having been a trustee, they would need Charity Commission permission, approval to appoint her as CEO, and also that her salary would need Charity Commission approval. So they quite rightly appointed an external consultancy to benchmark the salary level, and they came back with an indication of 80 to 90,000. So an initial application was made for her to take the role on a salary of £100,000. That was declined by the Charity Commission, and after some sort of internal discussions at the charity, they felt the Charity Commission would wear 85,000, so a revised application went in. That was then approved. Some of the flack around this area was that Mrs. Ingram Moore subsequently gave public interviews where she was challenged on her salary level as a CEO, and her statements were that she'd never been offered the job at more than £85,000, and that talk of six-figure salary was incorrect. There was lots of evidence that those discussions had happened at the higher rate, and so the Charity Commission included notes in their findings that they felt her comments were disingenuous, which I think just points to, within the sector, there is a higher bar in terms of expectation around transparency and openness than there might be elsewhere. It's not just about the strict letter of the law. So once appointed as CEO, Mrs. Ingram Moore also then had a contract as a personal role as an ambassador for the charity with Virgin Media. It's as a judge in some Connector awards. There were things in the agreement that required that referred to her as acting on behalf of the Captain Tom Foundation, and also required the foundation to include social media posts relating to the activities. Although the charity originally raised an invoice in its own name for £20,000, that was subsequently credited, and actually Mrs. Ingram Moore charged the Virgin Media £18,000 in a personal capacity, and then there was a subsequent £2,000 donation to the charity. Now, the non-conflicted trustees were not aware of that agreement, so they weren't able to challenge it and try and negotiate a better deal for the charity, but neither did they ask. So it happened, but they didn't get full information. The question comes up, how, given her employed role, was she able to undertake this role in her own name without that being a conflict of interest? And this was a really key thing for me. So when she signed her contract of employment and returned it to the trustees, she struck through the paragraph that related to conflict of interest. And she included a note when she sent it back that said, "I've signed the contract but removed the conflict of interest clause as this is not a legal requirement and given my responsibilities is too restrictive. It's a given that I will not be doing anything to conflict with all my roles, but I cannot be in a position that I have to request authority at every turn. My life would grind to a halt. I'm sure you understand." Well, I think we do understand now, but if I was one of those non-conflicted trustees and I hadn't pushed back on that, I think I would be feeling fairly uncomfortable at that point. So it's just, we all recognise that dealing with connected party rules, related party disclosures can be time consuming and a bit of a bind, but it's there for a purpose. And this demonstrates what happens when those things go wrong. Looking at fundraising activities with commercial partners, we've got 3 instances that are highlighted in the findings. And actually, I always think of these as the good, the bad and the ugly. So there was a Captain Tom Rose. It was covered by a proper written agreement with a commercial partner. People buying the rose knew exactly how much was going to the charity of the money that they spent on the rose. And the charity raised over £30,000 from the sale proceeds. Perfect. There is nothing wrong with a really well structured commercial agreement that raises funds for a charity if it's done in the right way. The bad, we get onto the gin distillery. So there was a written agreement, but it didn't cover all the products. There were comments on the website selling the products that all profits from the sale would go to the charity. So it was very vague, not compliant with the fundraising regulator requirements. And there was real confusion about what the trustees were aware of and what they weren't aware of because there was a consultant. So it was an example of where they tried to do it, but it had gone wrong and it wasn't well executed. The final one, which is around the book publishing deal, is frankly just where it gets ugly. So there was a publishing deal originally for 4 books, including the first one was Captain Tom's autobiography, negotiated with Penguin Random House, and the advance was 1.5 million. Now it's clear from lots of the discussions that were going on at the time through those negotiations that the publishers understood that some of the proceeds would be going towards the Captain Tom Foundation. They offered to split the advance between the company that was the family company Club Nook that had the rights to the name and the charity, but that was declined. There was various drafts of press releases which had to be watered down on advice from the lawyers for the publishers. They started from the sales were proceeds from the sales were going to the charity. It was watered down to in the end the book was being sold in support of the charity, but in fact no donations were ever made. So the whole of the advance sat with the family company, even when the Charity Commission, as part of the inquiry, gave the company and the family the opportunity to make a subsequent donation. They declined twice. On the next area, so they did also look at reimbursed expenses that related companies had incurred on behalf of the charity. Actually, they found that although they weren't properly disclosed, there was nothing wrong with the underlying nature or the amount. So that wasn't a major issue, and again demonstrates done properly it can happen. The intellectual property point is more, is probably quite unusual. It's not many charities that are reliant on intellectual property. The Charity Commission did advise the trustees at the outset about this, so they're probably very disappointed it wasn't addressed properly. The big issue that the charity had was because they didn't have a proper license agreement, they had no right to use the Captain Tom name. What that meant in practice was the family could withdraw the right for the charity to use the name at any point, which effectively gave them an imbalance of power, sort of power of veto, too much control. So the non-conflicted trustees hadn't undertaken their duties properly to secure the assets of the charity. And finally, there was the infamous building. Planning permission went in for a building on the Ingram Moors private property for a Captain Tom Foundation building, lots of references to the charity and charitable purposes. It was built. There was a subsequent retrospective amended application went in with no references to the charity, no references to charitable purpose, but an addition of a spa and pool. That was subsequently declined. It got a lot of media attention, and in February 24 that was actually demolished. So the outcome was that both Mr. and Mrs. Ingram-Moore were disqualified from being trustees or holding senior management roles. So bad for them personally. But the Charity Commission did also highlight that there were issues for the wider sector. If we just move on. So again, picking up on a lot of the themes that came from before, which was around conflicts of interest, payments that are to connected parties or trustees, and the tricky area of working with commercial fundraising partners. Those were the ones that came out of that one. I just wanted to finally end this session with a bit on a reminder that there are other risk areas that can be sort of red flags and trigger points for inquiries. Safeguarding, if you're involved with children or vulnerable adults, is clearly a high risk area. Working internationally, and particularly for working through partners overseas, managing finances there can be tricky, and the commercial fundraising point comes up again. And anybody who has the pleasure of actually submitting their charity's annual return will recognise that there's now some very tailored questions when you do that annual return, again funneling the risk to identify those charities working in that area. So then I'm just going to move on now to trustees' responsibility to prevent fraud. So I will mention briefly that there is a new corporate criminal offence from the 1st of September, which is about organisations preventing fraud rather than being focused on the individuals. So it applies to large organisations and not charity specific. They give some examples which are clearly sort of commercially driven. The example that I have from my previous work with charities and actually with construction businesses is I've had a situation where there was a charity where they were doing a large construction project. Some of it was funded by grant funding, and some was coming from unrestricted reserves of the charity. The allegation was that that invoices were being described in such a way that the work would qualify for the grant funding and use less of the unrestricted reserves. So that wasn't a potential fraud that was around individual benefit, but it was about somebody potentially trying to benefit the organisation. And so it's worth having that level of fraud on your radar as well. But if we move on to the next one, the good news is that for the actual criminal offence, large means very large, and so probably doesn't affect many people that we're working with. But it's a good starting point to think about what trustees' responsibilities are. In terms of fraud in charities, there's a lot of organisations that are involved in the counter fraud landscape. Auditors play their part, but charity trustees are at the heart of it. If we go on to the next bit, we'll see what actually the Charity Commission expects of trustees. And I think probably the first two boxes are reasonably high at most charities' agendas in terms of thinking about what the risks of fraud are and then taking actions to protect the charity. Always worth making sure in your work as trustees that you're actually checking the actions are working. So if there are controls in place that you are relying on, going in and making sure that those controls are operating as you intend them to. If we look at what the common risk areas for fraud in charities are, you'll see on the slide there are a number of ones. Gift aid is one I just want to highlight. It's been more prevalent in the news recently. There was a case at the tail end of last year where two sisters were actually sent to prison. They'd managed to claim £486,000 in fraudulent gift aid payments. They were guide group leaders, and they'd submitted fraudulent claims using real people's names, addresses, but just completely making up fictitious donations and claiming gift aid on them. That money came into the charity bank accounts, and then they had the subsequent fraud of actually taking that money out because this was for personal gain. Amazingly, they took a third of it out in cash. and the rest of it they managed to by using other people's identities, trigger it into their own bank accounts and withdraw it. So that's just a reminder to make sure that you've got proper controls over your gift aid claims and proper authorization levels in place. The other case I just wanted to mention was a sort of a much smaller scale fraud, treasurer of the John Eastwood Hospice, where it was the old case of cash from coffee mornings was not making it into the charities funds. A sad case of somebody with appears to have a gambling issue. The reason for mentioning that is part of the cover-up, but part of the reason it didn't come to light quickly was that there was one treasurer who had complete control of all the accounting records. It wasn't a large function, and they actually doctored the bank account statement. So when the checks took place, so they put the money through as if it had been received. It wasn't, but then they doctored the bank statement to make it look as if it had been. So just when you're doing your spot checks, just be aware and make sure that what you're looking at is definitely a genuine statement. And sometimes if you can check on screen live what the balance is, that can be a really effective check. So in terms of practical points, there's a really good Charity Commission guide, CC8, which the QR code on screen will take you to. And very worthwhile trustees just being aware of that and the pointers in that. But what do you do if you think you suspect fraud? The first thing to say is not to panic. So if we just move on a slide. And I think the key thing to do is before you reach this instance, just have a plan. So as a trustee board, as management, think through and have a written plan as to who you would contact and what you would do in the case of fraud. So you're not having to try and think about that cold in the moment, but do make sure you keep evidence and report it to the Charity Commission if you need to. So in summary, as trustees, I think really important to make sure you've got the right policies in place, to make sure your organisation has the right training in place, particularly around cyber fraud, and also then to have a plan to deal with fraud should it arise. Hopefully not, but should it arise. And then all of that can feed into your trustees annual report where you report your risks and how they're managed. So that's it from me, and I'll hand back to Neil.
Thanks, Sharon. Conscious time's ticking on, so without further ado, we'll hand over to Miles and John. For those who are wondering, the word Triodos comes from the Greek for meeting of three roads. So welcome to you both, and look forward to hearing from you.
Thank you very much. Good afternoon, everybody. We're going to bring another slight change of pace from the other presentations we've enjoyed so far on the webinar. Both myself and my colleague John Sharp are going to provide you with an introduction to an overview of Triodos Bank. So I'm going to pass over to John now, who will tell us all a little bit more about Triodos and its history. John.
Yes, good afternoon. Thanks, Miles. Good afternoon, everybody. So Triodos are a Dutch bank, been in existence for over 40 years, and we celebrate the 30th anniversary in the UK this year. It's got other branches in Spain, Belgium, and Germany, and we exist to support organisations looking to affect positive cultural, social, and environmental change. So it's green, ethical finance, social finance, impact finance, basically, or impact requirements. So we've got the UK head office is in Bristol. It's got about 300 odd staff. I've got satellite office in Edinburgh and in London. So that's a bit about Triodos. And I'll do a little bit of introduction about me. So I work in the wellbeing team. So it's a sector that principally covers healthcare, education, arts and culture, recreation, green tourism, and philosophy of life and faith groups. I've been at Triodos the last 5 years. Previous to that, been at NatWest for a number of years, 12 years, Barclays about 22, and in between worked for ThinkCats, Alternative Business Finance, for about 3 or 4 years. So a number of years in banking. What made me join Triodos? Basically the morals and the values and that sort of green ethical desire and ethos really to help those organizations that require funding from that perspective. So over to you, Miles.
Thanks, John. So as you know, I'm Miles. I'm a relationship manager at Triodos Bank as well, but I work within this small loans team. So for some of you who are interested, you might be thinking, what does that mean? The small loans team works with all of the customers that we have with Triodos with existing borrowing of less than £1 million, and any new customers who might approach us with funding needs of less than £1 million. And whilst John covered that he has sector specialisms, my team really doesn't have a specialism. We work across all sectors and customer types. So if you fit within our remit, and you want to work with us and you need to borrow less than £1 million, you might be unlucky enough to talk to me, or luckier to talk to one of my team. Some of the key ones we've worked with predominantly this year, sector-wise: agriculture, philosophy of life, education, housing, and some recreation customers as well. And John touched on the reasons why he joined Triodos. I, like John, have spent time working with some of the larger retail banks. I spent some time at HSBC before joining Triodos. And the reason I decided to join personally, for me, is that I found it very challenging to work with customers during the financial challenges we had for the COVID lockdowns, where we had lots of bounce back loans and CBILS loans that were put through, and it was very restrictive in that there was quite criteria-led lending. So you were seeing organisations you'd perhaps worked with for 3, 4, 5, even longer years, who didn't quite fit a box, so didn't get the funding they required, and that didn't sit right with me. So I left that organisation and tried to find somewhere where I felt that there was a organisation first approach, and Triodos was somewhere that I found, and then I found myself here after a few years on this webinar talking to you guys. So that's a little overview about me and my team as well. So moving on to the sectors that we support. We do support a wide range of organisations across a myriad of different sectors. The common thread running through all those with whom we work is that they do strive to work for positive environmental, social, or cultural change. And as it says on the slide, for over 40 years here in the UK and in our branches abroad, we've supported thousands of these organisations. What I would like to add, though, is that if you don't see your sector on this slide, it doesn't necessarily mean that we can't help. So we always welcome the opportunity to work with those making a positive impact, and we would encourage you to contact us so we can find out more about how we could support you and your organisation. So I'm going to hand back to John now, who will be starting our journey through a variety of examples of organisations we've helped here in the UK.
Thanks, Miles. So Avon Needs Trees. This is one of two sort of nature restoration examples, something I feel really passionate about. So this is a reforesting, rewilding business. So we've lent money in 2024 to purchase their farm or their hub where they operate from. And why Avon Needs Trees exists? Well, recent centuries in Bristol and Avon, they've lost most of their woodland. It's one of the most deforested parts of the UK, around 8%, where the average is 13%. So Avon Needs Trees have planted over 50,000 trees so far, purchased over 582 acres, and have over 1,000 volunteers. So a really good example of reforesting and rewilding.
Fantastic, thank you, John. So moving on to the next organisation we'd like to tell you about, we have Ruskin Mill. Some of you attending this webinar may be familiar with them and the fantastic work that they undertake. But for those of you who are not, they're an educational charity founded back in 1981 that operate across the UK, primarily based here down in Stroud. So Triodos they provide outdoor learning environments supported through the use of practical land space. Their aim is to foster and grow both work and life skills among young people with autism and other learning difficulties. Now, we've been a long-standing advocate and ongoing supporter of Ruskin Mill for many, many years. And a recent example of this was the provision of a loan to support the purchase and development of an 18-acre small holding on the outskirts of Bristol, turning it into the Grace Garden School. The school offers an education to young people aged between 7 and 16 with complex needs, and this also includes support for communication needs related to neurodiversity. It really is a fantastic charity, and I'd like to encourage any of you who are not familiar with them to take some time to find out more about them and the inspirational work that they do. John, I'll hand back to you.
Thank you. Chimpanzees, this is one I've been personally involved with. So Chimpanzees are a charity that are looking to help disabled children and young people have the play space and having fun, socialize, but they're unable to do that. So in 2024, we helped chimpanzees locate or relocate to this building, which is the old M4 services at OSC. So they raised money to fund the deposit. We've helped with the commercial mortgage for the remainder. And they're currently fundraising a significant amount of money to reconfigure and also install various bits of equipment inside that building to start opening around about June next year, all being well from that perspective. But this facility will be first of its kind in the UK. An interesting fact, 66,000 children and young people up to the age 25 with disability are living within an hour of Bristol, which I was astonished by, and don't have access to this kind of fun space. So this building will involve a soft play area, swing room, music room, active sensory room, quiet sensory, a gym, exercise studio, therapy room, and trampoline, to name but a few. So it can be really packed in, but it will be a fun centre, and they're looking to have more centres throughout the UK once that's been satisfactorily introduced. So over to you, Mars.
Thanks, John. Moving on to another hugely impactful organisation, we have 1625 Independent People. So this is a fantastic example of another charity that works very, very closely with young people. They do focus on supporting those who are homeless, leaving care, or generally at risk of homelessness, and they've been doing so for over 40 years. So they've been around longer than Triodos. Alongside the provision of safe and stable accommodation, they also provide practical and mental health support to ensure vulnerable young people can build healthy relationships, develop independent living skills, and really, really important, and something that's close to my heart, is access to employment and training to make sure that the next steps after they have been able to create a period of stability in their lives are able to be taken. It's something that's often overlooked. So it's very important to see that aspect. We've been working with them since 2005 when we provided a loan to enable them to move from rented to owned office and accommodation space in Old Market in Bristol. So this allowed them to establish permanent offices and training spaces in the city, as well as undertake improvements to the property to ensure it met their needs. So there will be certain aspects of the building that that need to be modified to ensure they can accommodate all of the young people that they assist. Interestingly, they still occupy this building as of today, where they are currently in the process of refurbishing it. And if you visit their website, they have a lovely section where you can find out all about the project, how you could help as an individual, and places where you can donate as well. So over now to John for our last customer that we'd like to share with you all. John.
Thanks, Miles. Just before I go into Trees for Life, whilst the vast majority of our funding is secured, we also have a crowdfunding site whereby those organisations that fit our criteria can raise money through bond finance on an unsecured basis. So they don't need to. So charities don't need to have freehold assets to borrow from us. So there is a slightly different way we look at things. So this was an example for Trees for Life. So we raised, so the crowdfunding site raised a significant amount of money in less than 48 hours to help with this new rewilding centre, to assist with the purchase of this rewilding centre in 2023. So that's a significant amount of money that was raised. And they planted over 2 million trees so far, and obviously keen on nature conservation and biodiversity, which is obviously really important for us. So that concludes. I think that might be the last slide.
Lovely. Yes, so we've come to the end of our presentation, and hopefully this has given you all a great overview of who we are, what we do, and a little flavour of some of the types of organisations we've supported. So from both myself and John, we'd like to thank you for your time with Triodos this afternoon, and also to PKF Francis Clark for providing us with the opportunity to speak with you all. Thank you very much.
Thank you.
Thank you both. Your contact details are on the slides here, so when we send the slides out, if people want to reach out to you, I'm sure that will be fine. So I'm conscious we're just slightly over time, but I think we've got time for one question in the Q&A, and I think this is one for Darren, around software as a service arrangements and whether these will need to be caught as right of use assets under the changes to the leasing standard.
Yeah, thank you. Yeah, thanks, Neil. Yeah, I think that's an interesting one. I think the answer is probably no in most circumstances. So one of the things in the guidance is obviously, firstly, you need to identify the existence of a lease initially. And I was just looking at the SORP while we were going through our other speakers, and that does say, a feature of a lease is that the leasee has a contractual right to control the use of the asset for the term of the lease, and that right of control prevents another party from using the asset at the same time, except with the leasee's consent. So I suspect in the majority of circumstances where you're getting these software as a service arrangements, you probably don't have complete control over that software service that you're getting. So if you're really paying to access a cloud service, for example, on someone else's server, you probably don't have control of an asset to put on your balance sheet, and therefore it's likely to just be an expense going through. There are probably circumstances and different circumstances where you may be able to reach a different conclusion, because there's often a lot of detail behind these things. So yeah, you might get to a different conclusion if, for example, somebody was doing a lot of work on your own systems to allow it to integrate with another service provider. But I think in the majority of cases you don't ultimately have control of that software, so it probably would carry on being an expense rather than being an asset.
Okay, thanks, Darren. If there are no other questions on the Q&A, I think we'll draw to a close there. Just to say thank you to our speakers, Darren, Sharon, Miles and John, and thank you to all of you for joining us online today. And we hope you found this session useful, and hope you'll be able to make the second session again this time next week. Thank you very much, and enjoy the rest of your day.
Thank you.